Jesse Livermore. How did the man who was considered the king of speculators or the pioneer of day trading manage to create his strategy to beat the market? Is Jesse Livermore the father of technical analysis of the stock market on Wall Street? Why is he known as the Wolf of Wall Street? What caused one of the best investors in history to die tragically at just 63 years of age? The New York Times, in its editorial, wrote the following epitaph about Jesse Livermore. What good things he did, what harm he caused, what life meant to him and others. All these questions are the stuff of a novel. He was carried away by his passion. He lived in an age when the speculation he carried out was like that of those boys who scratch for every last penny. He left no clouds of glory behind him and none of the human misery he had created before. The street on which he operated is no longer the same as before. His death has marked the end of an era. Jesse Livermore was born on July 26, 1877 in Shrewsbury, Massachusetts, United States, to a poor family. From childhood, his mother had already noticed his gifted abilities. Since at 3.5 years old, he was already reading and writing, and by the age of 5, he had already begun to read financial journals copiously. At school, he was able to complete 3 full courses of arithmetic in 1 year. At only 14 years old, his father forced him to withdraw from school so that young Jesse could help with the work on the family farm. But Livermore did not want to follow that path, since his dreams and passions did not involve work in the fields. Not content with this situation, the brave young Livermore managed to flee home with the help of his mother. They managed to gather $5 of the time, about $8,000 at present value, to seek refuge in Boston. While still a teenager, he managed to get a job at the Payne-Weber stockbroking firm. His job was to write the prices of stocks, commodities, and bonds on a whiteboard, which had to be updated every 10 or 15 minutes. Although it was a seemingly boring job, it allowed him to be in constant contact with the markets and their quotes. Thanks to his extraordinary innate talent with numbers and statistics, Livermore managed to find certain patterns that determined the changes in the quotes of the stock markets and commodities, managing to unintentionally understand how prices change. In order to understand the market, he kept his notes in a small notebook, where he wrote down the movements of the stocks and commodities. When he got home, he would rewrite the prices he had written on the whiteboard in order to store this data. Thanks to his skill with numbers, he analyzed the written data and had the ability to find patterns, to even predict the future of some quotes, based on historical prices and their movement patterns. For some, none other than Livermore is one of the fathers of technical analysis, even though initially he could not carry out operations due to his lack of money. At just 15 years old, he was able to predict the prices of raw materials, and he made his first transactions in the so-called bucket shops or betting houses of the time, which were found in the main cities of the United States in the 19th century, where one could bet on the rise or fall of a stock with little money. Later, the so-called bucket shops or betting houses of the time were declared illegal and disappeared in the 1920s. He managed to consolidate $1,000 in his trading operations, a fairly significant figure for the time at just 15 years old, higher than the benefits from his job, taking advantage of the available lunch hours where he escaped from work to operate the market. But his boss, Payne-Weber, did not like Livermore's behavior of accessing these betting sites. Initially, Livermore was warned to avoid betting in bucket shops. However, his stubborn ambition led him to ignore the warning and he was fired from his job. He then devoted himself full-time to trading in the bucket shops of Boston. However, due to his tremendous success, he was banned from these places. He even went so far as to wear disguises and use other names, but was eventually identified. At the age of 23, he arrived in the Big Apple of New York to operate in the Harris Hutton & Company stockbrokerage firm, where thanks to his tremendous success and his ability to predict the markets, he managed to turn $10,000 into $50,000 in just 5 years. But at his best moment, a tremendous blow came. He lost the stake he had in Harris Hutton & Company due to the slowness in updating the tape of a teletype, which prevented decision-making with the speed that was required. At that time, he began to analyze the reasons why he lost money in some operations, because although the mathematical system worked very well, sometimes emotional decisions took them out of focus and operated outside the mathematical framework, situations that would later lead him to different bad decisions and losses due to poor emotional management. He went through dark times. His wife left him, and he even asked for a loan to go to St. Louis, where he was little known, to return to the bucket shops, to carry out short-term betting operations or day trading again. but this time to avoid being discovered he hired other people and trained them to operate through third parties. Livermore managed to recover and return to the Big Apple of New York in 1901. He made an excellent operation by buying shares of the Northern Pacific Railway, achieving in this trade with an investment of $10,000 to achieve extraordinary profits to reach $500,000 at only 24 years old. In 1906, thanks to the advice of a friend, he made a short trade, that is, betting on a fall on the price of shares in the Union Pacific Railroad Company. Although at first the stock rose, which led to initial losses, a tremendous earthquake in San Francisco later caused a crash in the price of the shares, allowing Livermore to make a profit of $250,000 from this operation alone. Some even believe that Livermore had privileged information. But this streak of winning trades would lead him to overconfidence, making long purchases of Union Pacific Railroad shares. Livermore made this purchase on the advice of a friend who was the owner of Livermore's trusted brokerage firm, but he made a serious mistake when closing the position, losing $40,000 unexpectedly. However, he quickly achieved another successful operation in the financial crisis of 1907 by carrying out a short operation, that is, betting on the fall of the stock price. He was able to obtain in just one day profits of $1 million. Thanks to this operation, he achieved the reputation of bear raider or bear markets for his ability to bet short, foreseeing the fall of the markets. Due to his success, it is said that he even sent messages to the great J.P. Morgan to reduce his short positions and to buy shares at a low price. Thanks to his victories in the stock market, he managed to have a lifestyle that he would never have dreamed of in his childhood, even buying a yacht of more than 200 feet in length, which he called Anita, and buying luxury cars and expensive houses, as well as frequenting the most reputable clubs. In his life of luxury, he was also seen in relationships with famous actresses such as Lillian Russell. After the First World War, it is said that Livermore managed to control the cotton market, buying a huge number of contracts to gain control of the price. Due to his dominant position in the market, it was President Woodrow Wilson himself who called him to stop this operation. Livermore agreed to sell a good part of his positions, but the answer he gave to the question of why he had managed to control the market is anecdotal. Livermore accepted that he simply wanted to know if he was capable of achieving control of the cotton market. Although Livermore initially made profits of $10 million trading in cotton, he was able to manipulate the market completely. By 1908, he began to invest aggressively in commodities, especially in cotton futures, thanks to the advice of his friend Teddy Price, who was playing a trick on him because he was secretly selling his positions. Livermore had broken one of the golden rules of trading, which was to operate under his own criteria. Teddy Price was actually selling all his cotton positions and wanted to get out of the market, and he wanted to do so at a good selling price. Livermore took the bait and cotton prices quickly plummeted, leading to tremendous losses in his investments. Finally, his cotton trading led him to bankruptcy, and he lost practically 90% of his capital. Although he managed a small recovery by 1915, he went bankrupt. In order to operate, since he had no capital, some stockbrokers, taking into account his important career, gave him a credit of 500 shares to start operating again. Livermore knew that it was one of his last opportunities, and he made some investments with a high level of concentration and without taking into account the opinion of third parties. By 1917, newspapers were already reporting on his impressive recovery, which allowed him to rise from the ashes like a phoenix. His popularity skyrocketed, and his buying and investment recommendations were followed by a good number of market operators. By 1922, Livermore gave a series of interviews that would be the basis for the later publication of one of the most recognized works on investments and principles for operating in the stock market, Reminiscences of a Stock Operator. But once again, Livermore managed to recover, and for the great crash of 1929, he was able to observe and interpret some strange patterns that were observed in the market, quite similar to those of the crisis of 1907. It seemed that the patterns showed that smart money was quickly leaving the market. His wife Dorothy and his mother panicked because when they saw the market crash on October 29th on the news, they thought that Livermore was too exposed to the market. But when Livermore came home, he was happy, and it was because he had taken a short position, that is, betting on the market to fall. Despite the worst crisis in the stock markets, he managed to make a profit of $100 million by betting short, about $1.4 billion at present value, increasing his reputation as one of the great bears in the history of the stock market. But he fell into disgrace again, and by 1932, His personal life took a strong setback due to a lawsuit from a Russian lover and other inconveniences, such as his wife's alcohol problems, leading to a deterioration in his mental health and divorce, which led him to have assets of $84,000 and liabilities or debts of $2,500,000 in 1934, and to receive a suspension from operating in the Chicago Board of Trade Market. He tried to start a financial advisory business in 1939, based on his advanced knowledge of technical analysis, but by then he was already in the downward part of his career. Although he managed to publish one of his most important works, How to Trade in Stocks, on November 28, 1940, Livermore gave in to pressure and shot himself in a Manhattan hotel. William Delbert Gann, one of the most important stock market analysts of that time, in his book 45 Years on Wall Street, describes Livermore as a tremendous trader, but criticized him for having a special ability to make money, but he did not have an ounce of that ability to maintain the capital achieved. Literally, Gann stated that Livermore had the greed and energy necessary for success, but when he got a significant amount of money, he did not operate in a conservative manner. Livermore took the risk of trying out his own operations in the markets instead of having enough patience to wait for the natural trend to emerge, which the markets do not show on different occasions. That is, according to Gann, Livermore was a great trader, but he had no ability to manage risk in investments. These were some of his main teachings that are recorded in the book Memoirs of a Stock Operator. The first lesson is the importance of recognizing mistakes and maximizing profits. Livermore believed that mistakes were part of learning. Although in the stock market you can lose and win, no person is infallible. This means that mistakes must be accepted and learned from without falling into ego problems. But it is important to seek to maximize the profits obtained and minimize losses. Therefore, although it is not possible to always get it right, the objective is to seek a positive and favorable final result. The second lesson is to be able to read the market to the bears and the bulls, since the market continually moves between bearish and bullish operators. The objective of technical analysis is precisely to be able to identify trends and get ahead of the market to make decisions. Among the patterns are the lines of least resistance, which are the natural paths for or against the market. It is important to be able to get on these trends before other operators to benefit in the best way and maximize profits. Although it is not an infallible technique, it is a good guide to achieve excellent trading operations. The third lesson is to achieve independence in criteria. According to Livermore, the best thing is to make decisions based on your own criteria without being carried away by third-party opinions that can lead to significant errors and losses. To achieve this independence, you need to perform your own market analysis and have self-confidence in your decision-making criteria. This level is achieved with training based on reading different sources and significant experience in trading on the stock market. The fourth lesson is the importance of mental power in trading as a fundamental element to achieve success. Decisions should not be made based on fear or sudden emotions. A trader must forge his psychological capacity to be able to observe the market objectively, have a memory of what happened in previous years, achieve independence of criteria, have mental strength in difficult times, and the discipline to operate. The fifth lesson is to achieve the discipline necessary to achieve success in trading, closely related to the search for mental strength. But if we manage to stick to the proven plans and strategies, we will be able to keep emotions out of investment decisions. Part of the strategy must include a discipline to set objectives with entry and exit prices, the amounts to be invested in each operation. If we deviate from the strategy, we can get carried away by fears and other emotions that lead to bad decisions. In the description of the video, you will find the link to the best platform to invest in stocks on the regulated stock exchange in the United States. There is also the best course to learn technical and fundamental analysis to buy stocks. And finally, if you want to support us, there is the Patreon account so you can support us in creating more content.